Good evening and welcome to the Money Show. I'm Kavita Thapliyal and this is your trusted destination for investor education, financial awareness and smarter money decisions. That's right. In today's fast-changing world, managing money is no longer optional, it is essential. From rising expenses and changing lifestyles to market volatility and digital investing, every individual today faces one important question: how do I make my money work smarter for my future? And that is exactly what this show is here to help you understand. And this is the show where we also try and help you align your investment strategies with your financial portfolio and your investment and financial goals. So just in case you have tuned in, want to send across your questions, please do that. We'll flash our WhatsApp number on the screen, and we also have an email ID where you can reach out and send across your entire portfolio details, and with our experts we will help you align all your strategies with your financial goals. That's the number 8657974571, and the email ID is themoneyshow@etnow.tv. All right, but let's begin the show. And Indian mutual fund scales new peak. That's right. We are talking about the latest AMFI data, and as per that data, equity inflow surges 26.5%, mid-cap and small caps definitely dominating the space in the June momentum. The retail and institutional investors have firmly reasserted their dominance in India's financial ecosystem, catapulting the mutual fund industry to an unprecedented milestones. Now, according to the latest official data released by AMFI, the June 2026 net inflow into equity mutual funds staged a powerful recovery, surging 26.5 month-on-month to reach 28,973 crores. Now, this massive rebound effectively reverses the sharp 40% deceleration witnessed in May, when investors temporarily tightened their purse strings amid heightened macroeconomic friction, easing Middle East tensions and rupee stabilization measures. The crowning jewel of the June report is the historic performance of SIP book. That's right. Defying global market jitters, monthly SIP contributions breached a psychological barrier to hit an all-time high of 31,781 crores, up 3% from 30,954 crores in May. The unrelenting retail momentum paired with a strong capital appreciation lifted the industry's total AUM to a lifetime peak of 82.22 lakh crore. The numbers conclusively demonstrate the structural retail participation has evolved into a formidable counterweight to volatile FPI flows, providing a highly resilient localized cushion for Indian equity indices. Now, talking about mid-cap and small-cap performance that has taken center stage, and if you look at the numbers, they continue to serve as the primary engine for the active equity segment, massively outperforming large cap counterparts in fresh allocation velocity. Talking about the flows, as far as mid-cap is concerned, they lead the inflow charge. The category recorded the strongest month-on-month growth among major equity segments, drawing almost 6,090 crores in June. Now, this is a massive 39% surge from 4,385 crores in registered in May, reflecting aggressive investor risk appetite for mid-tier corporate earnings potential as well. Talking about small cap, again, the momentum is up over here, closely attracting almost 5,601 crores in fresh net inflows during June, representing 13.3% sequential jump from 4,945 crores recorded in the previous month, indicating that despite high valuation and strict regulatory warnings regarding market fraud, retail investors still believe in buying small cap dips aggressively. Large caps are also, as compared to mid cap and small cap, lagged far behind. But if you talk about the inflows, it's almost 2,067 crores, up from May's 1,592 crores. Meanwhile, large and mid-cap category, the blend fund saw a notable bump of almost 4,321 crores, and the multi-cap mandated secured almost 3,070 crores. If we talk about broad sectoral and performance trends, the underlying index performance heavily validated these retail fund choices. In June, we saw while the benchmark Nifty 50 rose by a modest 1.4%, mid-cap and small-cap indices registered much sharper recoveries, driving immediate NAV bumps across the active growth funds. Market experts also attribute this to resilient local economic indicators, strong credit growth, and healthy GST collections that point to a pending corporate earnings upgrades. Now, elsewhere in the ecosystem, sector-specific and thematic funds witnessed 127% rise in inflows to almost 1,469 crore, driven primarily by new thematic NFO pipelines. Hybrid categories remained highly attractive, with arbitrage funds bringing 5,799 crores. Multi-asset allocation fund captured almost 4,810 crores. Gold and silver ETF again staged a remarkable recovery, drawing in net inflows of 3,443 crores to completely reverse May's 725 crores net outflow. Conversely, the debt segment experienced a standard cyclical net outflow of 1 lakh crore, heavily dragged down by corporate liquid and overnight funds. Analysts caution against viewing this as a structural flight of capital. June definitely marks the end of the first quarter of the fiscal year, period historically characterized by heavy corporate withdrawals to service corporate advance tax obligations. Now, this institutional liquidity traditionally flows back into debt vehicles by late July. But let's dive deeper in this on these numbers, and let's understand the underlying sentiment of our investor. We are joined by Feroz Aziz, Joint CEO, Anand Rathi Wealth Limited. Feroz, hi, good evening, and welcome to the show. So we saw equity inflows swing back to 26.5% to 28,973 crores, Feroz, after a 40% deceleration that we saw in May. According to you, what changed? Are we talking about the psychological aspect of the retail investors to buy back into the market so aggressively this month?
Good evening, Kavita. Yes, the number, if you look at it month on month, it has gone up for sure, from 22,908 to 28,973, almost from a perspective of the active funds. Even on the passive side, there has been a reasonable inflow of money, about 13,238 crores of ETF money which has come, and there is a reasonable portion of that in equity because gold ETF inflows have slowed down considerably. People were buying gold only when it was at peak in Jan Feb. Now no one wants to buy gold when it's come down 20-25% from its peak. So that's a healthy number. One thing which I'm saddened about is whenever the net flow comes lower than the SIP number, that means SIP 31,780, like you said, approximately, is what the number in the form of SIP has come. If the net flow is lesser than that, that implies lump sum exits have superseded and taken away what 31,000 crores, 31,700 crores impact had. So generally, I always like to see how much greater than the SIP number is the total net flow. And here it is lower. That's the little sad part, but I'm not being overly pessimistic. So let me look at the number of SIP. What was it last June? That is when you get a sense, because month-on-month numbers also get distorted because some months have a 31-day month, like May was a 31-day month. And June was a 30-day month. Sometimes weekends come on the last day. So SIP debits can happen sometime later. So seeing them on a year-on-year basis gives us a lot of sense of what the direction is. Then, like you would have heard me say, 35 to 37,000 crores will be the end number for this financial year, in spite of the war and all the pessimism. Now, last June, the number was 27,268. So now if I see a 5,000 crore or almost a 5,000 crore increase, or 4,700, 4,800 crore increase on a base of 26,000 is 18% increase in the SIP number in a year where pessimism is at the peak. Nifty has done nothing for the last 2 years. So that's what excites me, and something saddens me. I thought I'll express that to your viewer.
So lump sum exit, let's just elaborate more on that. Why do you think that's happening?
See, that happens because, when large investors move money in and out, there are quite a few people who get carried away with, most people, large investors, especially HNIs or ultra HNIs, are long-term investors, still a catastrophe happens. Whenever markets fall significantly, like they did after the war, from 25,179 to 22,331 on 30th of March, once a person sees such a volatility, when there is bounce backs, they start taking out some money. That's what happens in situations where there's a sharp fall and then there's some recovery. That's what might have happened. Second, what happens is HNIs have moved money to more tax inefficient platforms like PMSs and AIFs. I don't know what the rationale could be. Unless an AIF gives me 5% more return per annum, there's no logic why I'll pay tax at a higher rate with the highest surcharge in a tax inefficient instrument, unlike a mutual fund. So these are the two primary reasons why HNI flows over the last 2-3 years have been very weak, because wealth managers want to sell PMSs and AIFs to their clients, leaving the very, very attractive tax efficient platform like a mutual fund for them.
Right. Feroz, let's also just analyze the numbers that coming in the mid-cap and small-cap category. You know, mid-cap funds surging almost 39%. Small caps also, we are looking at something around 5,600 crores. Are retail investors ignoring the risk metrics, or do underlying corporate earnings justify the relentless allocation? And because in the previous months, we've seen a dip in this category. Large and flexi cap have really outshined. They are still good as compared to May, talking about large cap, but mid-cap and small cap are really standing out.
Yes, mid cap and large cap are standing out. In, I think the last time I was on your show or another channel, I don't recollect, but these numbers we do provisional computations algorithmically. These numbers were known that they will be the highest in the recent times. Now, coming to your very important question, are we getting too overly bullish on the mid cap and small cap? Because money always changes performance. Large caps, because FIs own large caps, they've been selling large caps. So large caps are underperforming. So people keep buying more and more broader market. The calmness comes from the fact that both these put together, that's about 11,000 crores on a base of 28,000 crores. That's a skewed number, given the fact that large and mid cap also has some mid cap in it. So if you look at it, I think a little more bullish than I would want it to be, looking at the total number. If it was a 50,000 crore total and a 11,000 crores in small cap and mid cap, that's a very good number, because that would mean only 22%. Here it's almost about 35%, which is also okay, because our model portfolio has 45% in mid cap and small cap. The point I'm trying to highlight is, when you see it as a proportion of 28,000, it looks a little bad, but I'm still okay up to 40% total exposure, because flexi caps also have mid caps and small caps. Multi cap also has small cap and mid cap. Large and mid has mid cap.
True.
So on and so forth. If I look at the total, as long as it's less than 45% of the total sourcing, it's okay. And I think it'll be somewhere around 50 this time.
All right, but then you know what's really one of the highlights, gold ETF. 570% sequential surge to almost 3,442 crores, completely reversing the May's outflows. Now, interestingly, the completely defy global trends, where global gold ETFs saw major net outflows. What are we talking about in India? How do you decode this? India versus global gold paradox.
Yes, Kavita, that's a very interesting number which you threw up. When I see 3,000 crores, firstly, I feel sad that India has got enough gold. If as long as these 3,000 crores of inflow is coming by selling physical gold, I'm okay, because we have 4 crore crores of gold.
Right.
4 crore crores of gold is a lot of gold, right? You're speaking about 37 lakh crores in equity mutual fund and 4 crore in gold totally. So but the interesting part is, I'm not too saddened of a 3,000 crore inflow in a month of June, where the average prices in dollar terms have been 4,300, 4,200 also. I'd given an exit call at 4,800 on gold. But in January, if you see, 24,000 crores came into gold. And that was at the peak. So yes, I've not done too much study on the global gold outflows or inflows, so I'm not qualified to comment. But I'm still okay that 3,000 crores is significantly lower than 24,000 crores, which people bought at the peaks of gold ETF prices.
Right. Feroz, you also deal with a lot of HNIs. Now, for an HNI investor looking to allocate capital post-June, how should they time their move back into debt or arbitrage vehicle relative to this highly heated equity market now?
Kavita, I don't think equity is too heated. Let me give you some data points. One, from a price standpoint, the other from an earnings standpoint. Any time in the past 26 years, if you look at a monthly shift of Nifty and calculate 2-year rolling returns, you will get 291 observations of 2-year rolling with a monthly shift. Then we checked how many of them are negative after a 2-year Nifty negative return. That was 50 such instances. On all 50 instances, Nifty was positive if held for 3 more years after that 2-year period. So all of them were positive. Worst return was 4, best was 56, mean was 21.6, and median was 20.2, which implies whenever you see Nifty at a 2-year negative, it is time to buy whatever be the news. The news is going to be bad for sure. In all these 50 instances, if you actually picked up those newspapers back then, they almost read a doomsday, right? So, but 3-year returns were good. So I would say don't think that equity markets are overheated. The second fundamental and more earnings reason is last 10 years, Nifty earnings has gone up from 330 as per Bloomberg to 1,195 in FY26, 330 to 1,095, 1,195. That's the earnings growth on Nifty 50 companies. Of course, some companies would have changed. That's a compounded earnings growth of 12.9% for the last 10 years, Bloomberg being the source. Now, if you look at the price has moved by 9.3% compounded. मतलब दाम 9% से बढ़े and earnings 12% से बढ़ी. That means there is enough correction in valuation which has happened, which is what was the FII's concern about a year and a half back. I think that concern should be put to rest because the top two sectors of Nifty, which is banking and IT, which is 50% of Nifty, is at the trough, not at the peak.
Last question before I let you go. The result season now, so far the scenario is looking good and not too disappointing. What's your take?
Yes, so only 2 companies have given the results till yesterday because one of the companies was us, TCS and us. I am very hopeful. A 10% earnings growth this quarter over YOY of Nifty companies seems a very large likelihood.
To wrap up, today's AMFI numbers prove that the India retail investor is no longer just a participant. They are the ultimate market stabilizers. Now, with a record-breaking SIP book crossing 31,781 crore and a massive turnaround in gold ETF, domestic capital is showing unprecedented maturity by buying market dips and defying global panic. For any investor watching this momentum, and the takeaway from Feroz Aziz is clear: wealth creation isn't about timing these macro shifts, but about staying disciplined, managing risk over recency bias, and letting India's structural growth do the heavy lifting. Thank you so much, Feroz, with that, for being a part of this show. Thank you. All right, with that, it's time for a short break. But on the Money Show, we're going to get back after the break and focus on your portfolio queries. We'll be joined by Samisha, who will be talking to you live and answering your questions.